Assalamualaikum to Dr. Nuralina. My name is Alanur Iman binti Sazali, and today my team and I will present about analysis of corporate financial performance, a trend and comparative study of Darby, Plantation, Berhad and FGV Holdings Berhad. Moving on to the background. Firstly, Darby, Plantation, Berhad founded in 1910 and being listed in Bursa, Malaysia. Since the company already being listed in Bursa, Malaysia, it is a conglomerate company with business in plantations, property, industrial, motors, and healthcare. The company itself has a clear vision and mission to become the world's leading concentrated palm oil company. Next, we choose FGV Holdings Berhad of the full name is Felda Global Ventures Holdings Berhad as the competitors to Darby Plantation Berhad. This is because FGV is known as one of the largest plantation companies. They initially integrated as a commercial arm of the Federal Land Development Authority, or it calls as FELDA. FGV has been founded in 2007 and been listed in Bursa, Malaysia's main market in 2012. Their operations are focused on 4 sectors, which are plantation, sugar, integrated farming and logistics, and support business. Now we are moving to liquidity ratios. In liquidity ratios, there are 4 ratios, which is current ratios, quick ratio, and net working capital. However, I managed to find only 2 ratios for this assignment. For Darby Plantation, in current ratios, we can see that from year 2018 to year 2019, the graph is decreasing. It shows that Darby struggled to meet their short-term obligation, while from year 2020 to year 2022, the current ratio keeps increasing. It shows that Darby has the ability to pay its short-term obligation on time. Next, for net working capital, we can see from year 2018 to year 2019, the graph is decreasing. It shows that Darby has just enough capital to cover their short-term expenses, while from year 2020, it keeps increasing until year 2022. It shows that Darby has improving their business, therefore, they have an absolute measure in liquidity. Now, I'm going to pass it to Patricia to explain about activity ratio.
Thank you, Iman, for the explanation on liquidity ratios. My name is Nur Atira Batusha Daud, and next I will explain about the activity ratios of Darby, which consists of 5 elements, which is inventory turnover, average collection period, account receivable turnover, fixed asset turnover, and lastly total asset turnover. For inventory turnover, a higher ratio tends to point to strong sales, while lower one points to weak sales. Inventory turnover for Darby increased from 2018 to 2020 from 3.88 times to 8.34 times, which shows that they were having strong sales during that period and decreased in short on year 2021 to 2022. Next, average collection period refers to the amount of time a business takes to receive payment owed by clients in terms of accounts receivables. Companies use average collection period to make sure they have enough cash on hand to meet their financial obligation. So for Darby, the average collection period keep decreasing from 2018 until 2022. This means that year by year, the company has found more efficient ways to collect debt from their debtors more quickly. Okay, moving on to account receivable turnover, which measures the number of time that receivables are converted to cash during a certain period of time. Darby had experienced inconsistency throughout the year 2018 until 2021, which keeps showing low ratio. However, on year 2022, the ratio has increased numerously. And at this date, the company enjoys a high-quality customer base that is able to pay their debts quickly. For fixed asset turnover, Darby showed good performance on fixed asset turnover, which keep increasing on each year. Fixed asset turnover ratio reveals how efficient a company is at generating sales from its existing fixed asset. So from the studied ratio, it implies that Sime Darby's managements are using its fixed asset effectively. Lastly, the ratio for total asset turnover also keep increasing from year 2018 to 2022. Asset turnover is the ratio of total asset or revenue to average assets. So this metric helps investors understand how effectively companies using their assets to generate sales. Thus, we can say that Sime Darby uses their assets as best as possible to generate sales. So now I will pass to Aini to explain about leverage or solvency ratios.
Thank you, Batusha, for the explanation on activity ratio. So let me introduce my name first. My name is Aimi Adabintrus Mazalan. In this slide, I will explain about leverage ratio of Sime Darby Company. Leverage ratio is also known as solvency ratio. This ratio is used to measure a company's ability to sustain operation indefinitely by comparing debt level with asset, equity, and earning. So leverage ratio consists three sub-ratio. The first one is debt ratio, second one is debt to equity, and the third one is time interest spent. Next, let's look at the trend analysis. Trend analysis for debt ratio. Debt ratio is a financial metric that measures the proportion of a company's total asset that financed by debt. In debt ratio, higher ratio reflects the higher amount of debt to finance asset. According to the Sime Darby Company, the graph continues to show a decrease from 2018 to 2022. It showed that Sime Darby has a lower ratio, which indicates a lower amount of debt to finance asset. Second one is debt to equity ratio. The debt to equity ratio is a financial metric that compares a company total debt by its total equity. In debt to equity ratio, higher ratio reflect the higher amount of debt. According to the slide, the percentage kept decreasing from year 2018 until 2022. It showed that Sime Darby has positive shareholder equity. In other words, the company asset exceeds its liability. The third ratio is time interest and ratio. This ratio is also known as the interest coverage ratio. This ratio is a financial metric that measures a company's ability to cover its interest expenses with its operating income. It provides insight into the company's ability to meet its interest obligations on outstanding debt. In this ratio, higher ratio indicates that firm can meet loan requirement and lower risk of default. Based on the slide, from year 2021 until 2022, the decreasing shows that Sime Darby has a lower ratio indicates higher risk to investor and lenders. While from year 2019 until year 2021, the increasing showed that Sime Darby is able to meet its debt obligations.
Thank you, Aimi. Hello, my name is Nur Ala binti Muhammad Jaiz. Next, I will explain about Sime Darby's profitability ratio. This information is about operating profit margin from 2018 to 2022. Sime Darby showed a significant increase from 9.40% to 19.64% in 2021, indicating improved profitability in the next years. In 2022, Sime Darby maintained a strong OPM of 19.64% to continue the trend. For the net profit margin, Sime Darby's financial health has been followed by recovery and improvement over the 5 years. In 2018, Sime Darby had a moderate NPM of 4.78%. However, in 2019, the NPM dropped to 0.39%, creating a substantial gap between the 2 years. From 2020, the NPM improved from 10.42% to 13.44%, which showed a positive trend in 2021. However, it slightly decreased to 12.76%. Return on assets data proves that starting with 1.09% in 2018, the company ROA dropped to 0.16% and continued to increase over the year respectively. The increasing trend shows that Sime Darby has been improving its efficiency in generating profit in relation to its assets. However, return on equity information stated that starting with 1.98% in 2018 and dropped to 0.30% in 2019, Sime Darby continues to increase from 2020 to 2022, reaching 8.37%, 30.9%, and 14.11% respectively. The increasing trend shows that Sime Darby has been improving its profitability relative to the shareholders' equity over the years.
Thank you, Alaya, for the explanation. Now I'm going to explain about liquidity ratios that are already compared for Darby and FGB holdings. In current ratios, we can see the diagram that Darby Plantation has a higher ratio, which is 1.25 greater than FGB holdings, with 1.17 times. So, Darby has the ability to pay its short-term obligations on time rather than FGB holdings. Next is net working capital. Based on the diagram, Darby has higher value than FGB holdings. Darby has an absolute measure in liquidity, which means Darby's short-term financial is healthy.
Thank you, Iman, for the explanation. Next, I will explain about comparative analysis of activity ratio between FGV Holdings and Sime Darby. As compared to FGV Holdings, Sime Darby is less effective in their inventory management. FGV Holdings has sold its inventory at a rapid rate and handling their inventory efficiently to ensure there is enough goods to meet demand without creating excess. Next, average collection period refers to the amount of time a business takes to receive payment owed by clients in terms of accounts receivables. Companies use average collection period to make sure they have enough cash on hand to meet their financial obligation. So for Sime Darby, the average collection period keep decreasing from 2018 until 2022. This means that year by year, the company has found more efficient ways to collect debt from their debtors more quickly. Next, moving on to account receivable turnover, where FGV Holdings has higher ratio than Sime Darby. And as we know, a higher ratio is desirable as it indicates that the company's collection of account receivable is frequent and efficient, while low ratio suggests that the company's collection process is poor. This can be due to the company extending its credit policy for too long or extending credit terms to non-creditworthy customers who are experiencing financial difficulties. Next, from the fixed asset turnover ratios that I have compared, it shows that Sime Darby is less effective in managing their fixed asset compared to FGB Holdings, where FGB Holdings shows higher ratio in fixed asset turnover. Typically, investors are looking for investment opportunities in an industry with capital-intensive businesses may find fixed asset turnover useful in evaluating and measuring the return on money that they invested. Lastly, from the ratio of total asset turnover, FGB Holding is using their assets more effectively compared to Sime Darby to generate more sales because it has higher ratio, meaning that Sime Darby should improve their efficiency in using their assets to generate revenue because many investors use the asset turnover ratio to compare similar companies in the same group or sector to do decision making. So next, Amy will explain about leverage or solvency ratios of the same company.
So, in the comparative analysis, for debt ratio, as compared to FGB Holding Berhad, Sime Darby has lower amount of debt to finance their asset. Next one is debt to equity ratio. Sime Darby has lower ratio that indicates the lower amount of debt rather than FGB Holdings. For time interest earned, Sime Darby has a lower ratio than FGB Holding, and this indicates that Sime Darby cannot meet its debt obligations based on current income and will cause this company to have a higher risk of default.
Furthermore, the difference of profitability ratio for operating profit margin between the two companies in 2022 shows that Sime Darby's higher operating profit margin indicates that it has greater efficiency than FGV in generating profits from revenue. Other than that, for net profit margin, the graph shows that Sime Darby's higher percentage of 12.76% shows more efficiency in generating profit relative to to its total revenue than FGV. Sime Darby has a higher return on assets than FGV, shows that Sime Darby is more efficient in making use of their assets to generate profit. However, FGV is more effective in generating profits relative to the shareholders' equity than Sime Darby, and shows that FGV is making use of investor funds more efficiently.
So we can conclude that Darby Plantation Berhad had to ensure the obtainability of the liquidity and higher ability to meet their short-term obligation. The higher liquidity ratio from Darby Plantation Berhad reflects that the company is proactive in securing its financial stability. The investors often view sufficient liquidity to ensure the company can make them wealth by generating profit from the company. Darby needs to be strategic and consistent in managing customer credit. As compared to FGB Holdings Berhad, Darby Plantation Berhad needs to enhance its performance and management in inventory turnover as well as asset management to generate more sales every year. Darby Plantation Berhad also performs well in generating sales and controlling their costs, which leads them to have a lower amount of debt than FGB Holdings Berhad. This is reflected in the efficiency of debt management to finance their assets, and that will attract more investors and lenders. Over the 5 years, Darby Plantation Berhad has a good indicator that ensures the quality of business is high quality in the company's operation and is capable of generating returns for both debt and equity investors. As compared to FGB Holdings Berhad, Darby Plantation Berhad has a better productivity in generating profits but lower returns to shareholders.
To answer this question, in our opinion, from the report, Darby can implement transparent communication about credit terms, leveraging data analytics for accurate risk assessment, and regularly reviewing and adjusting credit policies based on market trend and customer behavior to enhance its sustainability in managing customer credit. Other than that, Darby could focus on optimizing its operational efficiency and implementing sustainable business practices to enhance its time interest earned and ensure long-term financial stability. Lastly, to enhance sustainability in terms of return on equity, fostering innovation and staying attuned to market trend can also contribute to long-term profitability.
From the analysis that we did, the overall report shows that our main company, Sime Darby, is better than FGV Holdings in many aspects, such as liquidity ratios, leverage ratios, and profitability ratios. Sime Darby has good indicator that ensures quality of business is high in company's operation and is capable of generating returns for both debt and equity investors. Sime Darby also performs well in generating sales and controlling their costs, which leads them to have a lower amount of debt than FGV Holdings Berhad. However, the company needs to be strategic and consistent in managing their customer credit because we can see that FGV Holdings has preceded Sime Darby's performance in activity ratios.
For the future outlook of the plantation industry, especially palm oil company, will face increasing pressure from consumers, investors, and regulators to adopt more environmentally friendly and socially responsible practice. Sime Darby, like other palm oil companies, is likely to face growing pressure to shift towards environmentally sustainable and socially responsible practice. This could involve adopting deforestation-free policies, improving worker welfare, and embracing sustainable agricultural practice to address concerns from consumers, investors, and regulators. Staying ahead in these areas may become crucial for long-term success and reputation in the evolving landscape of corporate responsibility.
That's all from us. Thank you.